Won't you leave my money alone?
Equal, it would make you vulnerable.
And often it is the wife who chooses divorce, and often she has met someone else, and she's moving on to a new deal, and it's her expectation that she's going to take along the children, a substantial portion of our client's paycheck, at least in the form of child support and potentially in the form of maintenance, and the better part of the marital asset.
Hello, my name's Joe Cordell. Welcome to another episode of Cash Counsel. This episode I wanted to talk about the issue of investments. Where do we go from here? Many of you have been watching with great anxiety how your 401ks and your other securities have been performing, other investments, real estate prices. It's a real crazy time in our economy now. And there's a lot of uncertainty. There's uncertainty for reasons relating to a presidential election, which we're not sure. Many people are not. The markets certainly are not sure about what lies ahead in January and over the next 4 years with a new president. It's also uncertainty relating to the banking industry, and that seems to have had ramifications around the globe. So what happens in America is no longer simply a matter of America's economy being impacted, but it impacts world economies. And to some extent, what's happening here is a result of things that are going on internationally. It's very much an interwoven web, the economic community of the world, in a way that it never was before. So we are in unfamiliar territory when we try to predict what effects particular events in particular industries will have overall. And yet that's something we have to do because we have to make decisions about our investments. Many people feel like there's not the opportunity to recover over time that exists for those who may have a horizon for retirement of 20, 30 years in the future. Some people are right on the threshold, so they thought of retiring, and now they're looking at their portfolio being worth perhaps 2/3, in some cases half, of what it otherwise was. And for those who have a horizon that's much shorter, where they're having to make a decision of whether or not they're going to retire at all now, there's not the range of opportunity, and I'm not going to direct my remarks primarily to those, because I don't think that those people are the majority of the audience of Cash Counsel. Cash Counsel, I think for the most part, is people who are probably in their mid-years of planning, and as a result I want to kind of focus what I have to say from that perspective. And that it certainly will apply forcefully to those who are in the early years as well. But I'll just give you my thoughts about where we go from here and kind of what my perspective is regarding investments, because I think that is what, at the end of the day, Cash Counsel is about. It's about preserving your assets and maximizing their value where the opportunities exist. So when I look at my situation and those of people I know, you have to decide, do you sell out with your portfolio now, or do you hang on? And I think that's a question that's pretty easy to answer. When you look at the long haul of what's happened with the Dow and Standard & Poor's and other measures of overall market performance, the message is unequivocal. It's very clear. There's no exception over a 10-year period that the market has not returned. I mean, the market does return, and given enough time, it will ultimately be higher than it is now. And all you have to do is look at a 50-year history, starting with even periods before the Great Depression, which sat in the last quarter of 1929 and continued, depending on which economist you accept, to the end of the 30s. Some would say that it was actually the World War II that brought us out of the Great Depression. I think that's accurate. But others would have it tailing out in the mid-30s and a subsequent recession kicking in the latter part of the 30s that was to some extent independent. However you look at those graphs, the message is clear. You see that the market over any 10-year period is going to return, even in that crisis scenario. And we certainly have been through a number of crises in this country, things that at least are equal and I would argue will dwarf whatever we're looking at now. The banking industry certainly can have ramifications for a variety of industries, arguably every industry, but there's no question that we've been through things that are worse in the past, and we've seen this pattern continue. So those of you who are contemplating selling out now and moving into some other security, I would say, you need to pull back, take a deep breath, and look at history. History has to be your guide to the future. There's a tendency, particularly among the very young, to think that what they're facing now is something very new, and that seems to be, you know, a recurrent misconception among the young, and we all were guilty of it at that point in our lives. But as we get older, we start to see that our experiences have not been entirely unique, and what we're going through now is not historically unique. And furthermore, I'd add this point: to the extent that you sell your portfolio, where do you go from here? What security do you buy? What investment do you go to? If your logic was that I'm not going to participate in stocks when they're down, then that rules out real estate. And arguably, your logic by extension would rule out the bond markets while they're doing better now. Ultimately, in other words, grade A securities in terms of debt is doing well. But remember, those same forces that produce a favorable tide now will produce an ebb in the future. And those who take refuge in metals, remember, when you're holding metals, if you're holding the metals themselves, then you're not getting any rate of return. It's sitting as it is, and you have to count entirely upon appreciation for gains. There's no income, there's no velocity of capital that's going on there. You have to question any decision to sit and hold metal. It's the money under the mattress approach, except in that case you're hoping the mattress will appreciate. And it's true that if there's any relationship that consistently accounts for the ebbs and flows of prices in the metals, particularly gold and silver, it is a crisis scenario, whether it's inflation, whether it's wars. You know, the thread that runs true in predicting the performance of metals seems to be a crisis. But I don't think you want to live your life based on that sort of survivor mentality. You know, that's the sort of person I think who would choose to live barricaded in the mountains of Utah or Wyoming or such places. And I think that we have to have some optimism about the future. And that's not being naive. It's as a matter of fact, being very level-headed and realistic about what lies ahead based on what's happened in the past. So I'm not a fan of holding on to metals. Sure, you can buy the securities, but you're back to investing in things other than the metals themselves when you buy the securities. You're betting on a stable economic system to some extent. I think that people who have the stomach for it should not only hang on to the securities they hold now, but they ought to do something else. They ought to buy additional shares. There's a concept called dollar cost averaging. Dollar cost averaging takes advantage of the fact that if you're buying a certain number of shares at $100, when it's $100 a share, putting in the same amount of money, whether it's $10,000, whether it's $1,000, whenever you're buying those shares and the stock plummets to $50 a share, if you invest that same amount of money, then you're by definition what? You're buying twice as many shares. And if it goes down 2/3, then you're buying 3 times as many shares. So if you do that math and think about how it plays out in the future, as the shares recover, what's the average price per share? Well, that's where the idea of weighted averages come in. Remember, you'll have twice as many shares in that first example as you did at your original purchase price. So there's a lot more weight in that average. There are 2 times the weight in that average to calculate for your average cost per share. And you can see mathematically where that puts you. It puts you mathematically much closer to the bottom number than the higher. So what you're effectively doing when you not only hang on to what you have as prices go down, but you continue to invest the same amount you have been investing, then you're creating an average that's coming much closer to the new price than the original high price. It's called dollar cost averaging. And those of you who have the ability to put in the money where you keep your averages so low, then you're bound to make not only your money back, as I was describing previously in this discussion, but much better. It becomes an opportunity in which you get a potential windfall. And I think that's the strategy that makes sense, assuming that what accounts for the diminution of prices is entirely market-based. Now, if there are problems with your particular stock, things that are more fundamentally related, then sure, it's not a good idea to buy more when that stock goes down. I'm making an assumption that this depreciation or decline is market-based. And under those circumstances, dollar cost averaging is a really smart strategy. It takes a lot of fortitude. You know, you got to have discipline when everybody else is running out of the theater thinking it's on fire to buy a ticket to enter. It takes some fortitude. But those are the people who ultimately make a lot of money. So you got to pay some attention to fundamentals, though, in making that decision.